Welcome back to the deep dive. Today, we're really digging into the recent performance of Baazar Style Retail Ltd. We've got their Q2 and H1 FY26 results here.
Yeah, and it looks like a pretty explosive period for them.
Definitely. We want to go beyond just the headline numbers, figure out the strategy, what's really driving this.
Right. And BSRL, it's
Huh.
worth remembering, they're not just any retailer. They're a big player in value fashion, especially focused on Eastern India. Think West Bengal, Odisha.
And they have that specific cluster-based approach going into smaller towns, too.
Exactly. Really targeting those underpenetrated markets.
So our mission today, let's skip past the big revenue figures and find those nuggets, the operational stuff, the strategic choices causing this, well, this acceleration we're seeing.
Let's unpack it. Their core idea, their pitch, is really aiming for that national value leader spot. It's summed up in that phrase they use.
Oh, the style for the entire day is 1,000 rupees thing.
That's the one. It connects aspiration with, real affordability. It seems to be landing.
Well, the Q2 numbers certainly suggest it is. Let's hit those financials. Q2 revenue from operations, up 71% year over year. That's 5,317 million.
Huge jump. And for the first half, H1, it was over 9,096 million. Still, a 55% growth year on year. Very strong.
But the profit side, the EBITDA, that's where it gets pretty wild.
Yeah, Q2 EBITDA jumped 184% year over year. 184% to 691 million.
Wow.
And for the half year, H1, it was up 92% to 1,274 million. That really points towards better operations, better cost control as they scale.
Okay, but let's talk same-store sales growth, the SSSG. Q2 looked great at 22%.
Strong, yeah.
But the first half overall, H1, only averaged 10%. That's quite a gap. How much of Q2 was just the Durga Puja festival hitting early this year?
That's a fair question. The early festival definitely pulled a lot of buying into Q2. It happens across retail, that kind of quarterly variation.
So is the underlying engine still healthy, or is it too reliant on that festival bump?
Well, the festival timing explains the big Q2 number, yes. But look, that H1 average of 10% SSSG, that's still solid. It shows there's real underlying demand, people shifting to organized value retail. It's not just the festival.
Okay, makes sense. Let's shift to operations then. They're scaling fast, 250 stores now, up 36%. On track for their 40-50 new stores goal this year.
Which is ambitious.
Right. But scaling often brings problems, complexity. Where's the evidence they're managing it well? Was there a key breakthrough?
I think the documents point pretty clearly to inventory management. That's the big one.
Ah, the inventory days number.
Exactly. It dropped sharply. From 108 days in Q2 last year down to just 86 days this Q2.
That's a 22-day drop. What does that actually mean strategically?
It's huge for working capital. Think about it. Cutting 22 days means cash isn't tied up in stock for as long.
Right, freeing up money.
Money they can use.
Yeah.
It basically helps fund those new store openings, Reduces their need for borrowing. Their existing stock is, in a way, funding future growth. It's efficient.
And that efficiency probably feeds into other metrics too, like sales per square foot.
It does. SPSF was up 22% in Q2 to 865. It all connects.
This ties into the new store economics they laid out. They talk about pre-index EBITDA. Why focus on that specific metric before the lease accounting stuff for a new store's health?
Good question. It helps you see the pure operational performance of the store itself. Pre-index strips out the, let's say, complex accounting for leases required by IND AS 116.
So it's just how much cash is the store generating from selling clothes versus its direct costs?
Pretty much. They expect a new store starts around 5-6% pre-index EBITDA in year one, then ramps up.
To what, like 8-10% in year two?
Yeah, and then maturity, especially in those tier 2, 3, 4 towns, they see it hitting 13-15%.
Interesting. And they noted the difference between tiers, right? Metros might sell more per square foot.
Over 10,000 SPSF sometimes, yeah.
But the tier 2 and 3 stores with lower rents, that's where the consistent high margins probably come from.
That seems to be the sweet spot for their model. Lower costs, strong demand. Okay, so operations look sharp. But controlling costs and consistency, a lot of that comes down to the product itself. Which leads us to their private labels. How big a deal is that now? Oh, it's massive. Dominant, really. Private label sales shot up 119% year over year in Q2.
119%. Wow.
And it's now 58% of their total sales in Q2. 59% for the first half. They're increasingly selling their own stuff.
And they got that one big brand, Square Up, that did really well.
Huge. 2,265 million in H1 revenue just from Square Up.
And the target is even higher?
Yeah, they're aiming for 65% private label contribution by FY27. It's ambitious.
What about the margin difference right now? Are their brands much more profitable than the others they sell?
Not hugely, actually. The current margin difference is pretty slim, maybe 0.75% to 1.5%.
Interesting. So what does that tell you?
It suggests the strategy right now is about building volume and grabbing market share. Get people hooked on the brands with attractive prices first.
Build loyalty.
Exactly. Then maybe later, once they hit that 65% and have strong brand recall, they can focus more on widening that margin. It's a long game.
Makes sense. And to manage all this scale, especially the inventory and private labels, they need tech. They're putting serious money into it.
Yep, 20 to 25 crores this year, part of a larger Euro crore total CapEx plan.
What are the key systems? SAP Info. What problems are they trying to solve as they push past 250 stores?
It's all about control and intelligence for that cluster model. SAP is the big ERP, the brain. Info is for the warehouses, getting smarter about stock levels and replenishment.
So basically digitizing the flow to keep those inventory days low even as they grow fast.
Precisely. Maintain that 86-day cycle or even improve it. And Domo is for the analytics, the business intelligence side, to actually manage these clusters effectively.
Got it. Okay, let's do that quick technical detour. IND AS 116, the lease accounting standard. They reassessed their leases and got this huge one-time gain, 552 million or so. Can you break that down simply? Why did tidying up lease accounting give them a big gain and help future profits?
Okay. Basically, IND AS 116 makes companies put most of their long-term leases onto the balance sheet as assets and liabilities when they reassessed or restructured these leases.
Maybe got better terms or clarified the length?
Something like that. It effectively reduced the size of the future lease liability they had recorded on their books. Reducing a liability creates a gain on the profit and loss statement. That's the one-time bump.
Okay, the one-time gain makes sense. What about the ongoing benefit?
The long-term plus is transparency and predictability. The gap between their operating profit, that pre-IND AS number we discussed, and their final reported profit under IND AS rules. That gap is going to shrink a lot.
How much?
They expect it to be only about 10% next year. And this adjustment should also give them a recurring PBT benefit, maybe around 50 million per quarter. It just makes their results cleaner, easier to understand.
Right, less noise from the accounting rules.
Exactly.
Okay, so strong performance, cleaner accounting. That led them to raise their guidance for the year, right?
Yes. They bumped up the full-year top-line growth guidance. It was 25%, now it's a range, 25% to 30% for FY26.
And looking further out.
They're still aiming high, talking about 25% annual revenue growth aspirationally, targeting 6-7% SSSG for the next couple of years, and hoping to hit a pre-NDS PAT margin of 4.5% by FY27. They clearly expect these efficiencies to stick.
Let's wrap up with that interesting detail about how they handled the GST changes on clothes. It really shows their consumer focus.
Yeah, that was a neat move. Remember, the GST rates went down for mid-range stuff between Euro 1,000 and 2,500, but actually went up for items priced above 2,500.
So how did BSRL handle that complexity for the customer?
They kept it simple and very pro-consumer. They pass on the discount benefit that's 6.25% across all products priced above 1,000.
Wait, even on the items above 2,500 where the tax technically increased for them?
Even there. Their reasoning was that the volume of those really high-priced items was, quote, negligible. So they decided giving the discount across the board was better for reinforcing their value message.
That's smart. It avoids confusion and makes every customer feel they got a good deal, builds goodwill.
Absolutely. It plays right into the trends they're riding.
Yeah.
More disposable income in smaller cities, and younger shoppers everywhere looking for value.
So putting it all together, strong growth, improving operations, smart private label play, tech investments, cleaner financials, it's a compelling picture.
It really is. But maybe the final thought looking at the sources. India's value retail space still doesn't have one dominant national champion.
Right.
BSRL has proven its cluster model works incredibly well regionally, especially in the East. But they themselves admit, with their current concentration in Bengal and Assam, getting that revenue mix more balanced nationally, expanding properly into places like UP and Bihar, that might take until FY28.
So the big question is, can they translate that regional success into true national leadership? How smooth will that transition be?
That's the journey to watch, definitely. From regional powerhouse to potentially a national giant.
A fascinating space indeed. Thanks for walking us through all that.
My pleasure. Always interesting to dig into retail.
You can find links to the earnings call transcript and reports we talked about today in the show notes. We'll catch you on the next Deep Dive.